Hey everyone, and welcome. You've heard it a million times, right? Buy the fear. But how do you actually know when the market has hit peak fear? How do you tell the difference between a generational buying opportunity and just, catching a falling knife? Well, today we're going to decode crypto fear. We're going to dive into the kind of data-driven tools the pros use to get a real edge so you can turn all that market panic into a real actionable strategy.
So here's our game plan for today. We're going to kick things off with the classic fear gauge, the one many traders have been using for years. Then, we'll peel back the layers on a huge new blind spot that's developed in the market. After that, I'll introduce you to a much more powerful metric for measuring all the cash, or dry powder, that's sitting on the sidelines. And crucially, we'll learn how to use these tools together to avoid a really common market fakeout. Then, we'll tie it all together with a concrete, step-by-step action plan you can actually use.
So this really is the million-dollar question, isn't it? It's easy to say be greedy when others are fearful, but what does peak fear actually look like? I mean, how do you put a number on it so you can act with some real confidence instead of just guessing based on emotion? That is the exact problem we are going to solve right now.
Okay, let's start with a classic. For years, some of the savviest traders in the space have been watching one key indicator to get a read on market sentiment. And we're talking about tether dominance, or as you'll see it on the charts, USDT.D.
So what is it, really? Well, in simple terms, USDT dominance just measures how much of the entire crypto market's value is being held in Tether. Now, Tether is the biggest stablecoin, so think of it as the market's main cash reserve. When people get nervous, they sell their Bitcoin, they sell their alts, and they run to the perceived safety of USDT. This metric tracks that exact flow.
And here's where it gets really powerful. There's this beautiful, simple inverse relationship. When USDT dominance goes up, that means fear is rising. People are cashing out. And historically, that's been a pretty reliable signal that a Bitcoin bottom might be close. On the flip side, when USDT dominance goes down, it means greed is taking over. That cash is pouring back into the market to buy crypto. And that often signals we're getting close to a Bitcoin peak.
And hey, don't just take my word for it. This isn't just a theory. The data speaks for itself. I mean, look back at the cycle peak in November 2021. Absolute peak euphoria, right? USD.D was way down at 3.2%. Then fast forward to the FTX collapse in 2022, total panic. What happened? USD.D skyrocketed to 9.5%. The pattern holds up again and again. Peak greed means low dominance. Peak fear means high dominance.
So what this tells us is that we can actually start to map out some zones. When you see USDT dominance climb above 8.5%, you know you're in an opportunity zone. Fear is extremely high and a potential bottom is forming. But if it drops below 4.0%, watch out. You're in the danger zone of extreme greed. That spike we saw in February 2026 to 9% was a huge deal. It meant fear was back at the same insane levels as the FTX crash.
Okay, so USDT.D is a great tool. We've established that. But, and this is a really big but, the market has changed. Relying only on USDT.D today is like trying to drive a car by only looking in the rearview mirror. You're missing a massive blind spot right in front of you.
I love this analogy because it hits the nail on the head. Checking USDT.D is like checking the weather forecast. Yeah, it tells you if it's sunny or rainy right now, but it doesn't tell you about the tide. It doesn't tell you how much water is actually in the ocean, waiting to come in. You're missing the bigger picture. And here's why that is. A few years ago, Tether was pretty much the only game in town when it came to stablecoins. But today, billions and billions of dollars are also held in other stablecoins, like USDC.D, and a whole bunch of others. So if you're only watching Tether, you are literally only seeing a fraction of the total cash sitting on the sidelines.
So, how do we fix this? How do we see the whole picture? Well, we need a wider lens. We need a tool that measures all of the dry powder in the ecosystem. And that tool is the Stablecoin Dominance Index.
The Stablecoin Dominance Index, or STABLE.C.D, is pretty much exactly what it sounds like. It takes the market caps of all the major stablecoins, USDT, USDC, you name it, bundles them together, and measures their combined weight against the total crypto market. This gives you a complete, holistic view of all the capital that's waiting to make a move.
And we are not talking about small change here. The amount of capital we're talking about is just mind-blowing. As of April 2026, there was over $315 billion parked in stablecoins. That is a massive ocean of liquidity that can move markets in a huge way, and Tether is just one part of it.
And this is where you really see the blind spot in action. Look at this example from April 2026. If you were only looking at USDT dominance, you'd see a number around 5.4%, but the real picture, the total stablecoin dominance, it was way up at 13.45%. By only looking at Tether, you would have completely missed the true level of fear and the massive buying power building up in the market.
Okay, so we've got two powerful metrics now. How do we put them together? This is where the strategy really levels up, because by combining them, you can learn to spot and avoid one of the most common traps in all of crypto trading.
So picture this. You're watching the charts. You see USDT.D start to drop. Now, based on the old model, you'd think, yes, this is it. Money is flowing back into Bitcoin. Time to go long. But hang on. You might be walking right into a trap.
And that is the critical question you have to ask yourself. Is that drop in Tether's dominance happening because people are genuinely buying crypto, or is there something else going on? Without our second metric, you just can't be sure. And this brings us to what I call the stable swap trap. Here's how it gets you. Step 1. USDT.D falls. It looks like a textbook risk-on signal. But then, step 2. You check the total stablecoin dominance, STABLE.C.D. And it's basically flat. The total amount of money on the sidelines hasn't budged. The conclusion? Investors weren't buying Bitcoin. They were just swapping their Tether for, say, USDC. It was a complete fake-out. No new money actually entered the market.
You know, the legendary investor Stanley Druckenmiller said it best. It's liquidity that moves markets. Our job is to track the true flow of that liquidity. By using both of these metrics together, we can finally confirm whether capital is actually moving into Bitcoin and alts, or if it's just shuffling around between different stablecoins. All right, let's tie this all together. Let's build a clear, actionable plan so we can use this knowledge to spot those perfect, high-conviction opportunities.
We're going to borrow a concept from another legend, Warren Buffett. He always talked about waiting for the fat pitch. In baseball, that's the slow, easy ball right over the middle of the plate. In investing, it's that rare moment of maximum opportunity with minimum risk. And these metrics, they're going to help us see it coming.
Think of this as your playbook. If USDT is falling but the total stablecoin dominance is flat, that's the fake-out. Your move is to wait. If both are rising, that's real fear entering the market. Time to get your shopping list ready. If both are falling, that's the risk-on phase. Capital is flowing in and you just hold. But here it is, the magic moment, the fat pitch. It's when both metrics are peaking. That signals a true bottom, and your move is to start accumulating.
So, if you remember just one thing from all of this, let it be this. Watch for the moment when both of these metrics are peaking together. That's your signal that the maximum amount of cash is sitting on the sidelines. The selling is exhausted. That is the point where maximum fear truly equals maximum opportunity.
We'll end with one last piece of wisdom from Buffett. By using data to see the real story, you can stop being an impatient reactor and become a patient strategist. You can wait for the market to serve up that perfect pitch and let the impatient traders hand you their assets at a deep discount. The only question left is, when that moment comes, will you be ready to swing?